Welcome to the Deep Dive. Today, we're unearthing a really fascinating company, one that operates, largely out of the spotlight. But it's this quiet powerhouse behind some of the biggest advancements in human health. A business you might not have focused on, but its impact is, immense. So, what's our mission for this Deep Dive? We've gathered a stack of sources, we've got a detailed investment memo, company reports, even some interesting anonymous scuttlebutt, all focused on Danaher Corporation, ticker DHAHR. Our goal is to cut through the noise, pull out the most important bits, and really get our heads around its unique business model, its competitive advantages, and, what makes it such an enduring force. Think of this as your shortcut to understanding a company that really underpins global life sciences.
Yeah, and what's truly fascinating about Danaher, I think, is how digging into this one company can really illuminate these broader critical trends in healthcare and technology, and also how a truly unique operational system, their DBS, can create just significant long-term value. It's quite a masterclass in strategic execution.
That's a great setup. So let's peel back the layers on this business. At its core, how does Danaher actually make money? And what gives it that staying power?
Fundamentally, Danaher is the picks and shovels provider for global life sciences and diagnostics. They design, manufacture, market the essential instruments, software, services, the stuff scientists and clinicians rely on every single day for research, drug development, patient diagnosis. But here's the crucial part, right? They also provide the high-margin consumables, the proprietary reagents, test cartridges, the things those instruments need to actually operate. It's about being indispensable.
That sounds like a powerful combination. Okay, so if I'm hearing you right, this sounds a lot like the classic razor and blade model. Can you explain how that plays out for Danaher and, why it makes their revenue so sticky?
You've hit on a core aspect, absolutely. The initial sale of a sophisticated instrument that's the razor, it establishes this long-term relationship with the customer. And from that point on, they generate predictable, high-margin, recurring revenue from the proprietary consumables, those are the blades, and also from ongoing service contracts. And the numbers really, really back this up. As of fiscal year 2024, an astounding 81.11% of Danaher's total revenue was classified as recurring.
81%? What?
Yeah, and that's a significant jump from prior years, too. It really shows how deeply embedded they are in their customers' workflows.
81% recurring revenue. That's just an incredible level of predictability, stability, and I guess that's the foundation for their endurance, right? So how is that operationalized across the business? How's it structured?
Indeed, yeah, that level of recurring revenue is a testament to the endurance of their model. Operationally, they're currently structured into three focused segments: biotechnology, life sciences, and diagnostics. And these aren't, speculative areas. They're absolutely foundational to modern healthcare and scientific progress.
Right. And the endurance isn't just about the structure, is it? It's anchored in some really powerful, long-term secular trends. What are those big shifts that are basically carrying Danaher forward?
Absolutely. Think about it. First, aging global populations. That inevitably drives increasing demand for diagnostics, for therapies. It's just demographics. Then there's a dramatic rise of biologics and these complex medicines, like antibodies becoming vital for treating cancer, autoimmune disorders, and also personalized medicine, tailoring treatments to individuals.
Right, requires incredibly sophisticated tools.
Exactly. Sophisticated research and manufacturing tools. And finally, just the relentless march of technological advancement in healthcare. AI in drug discovery, genomics, advanced molecular diagnostics. It creates this perpetual need for new, innovative instruments, new software. These drivers aren't fads,
Right.
They're fundamental to human health, to scientific progress.
What's also critical to understand, from what I'm gathering from the sources, is Danaher's pretty remarkable strategic transformation over the past decade. It wasn't just small tweaks, was it?
Not at all. It was very deliberate.
Yeah.
Systematic.
Yeah.
Management strategically divested slower growth, more cyclical industrial businesses, think Fortive, Veralto, and they intelligently redeployed that capital. They moved into higher quality life sciences companies. Mm-hmm. Acquisitions like Sativa, Aldebaran, Abcam. This wasn't just about getting bigger revenue numbers. It was actively sculpting a business that's significantly more resilient, more predictable.
De-risking the future, basically.
Precisely. De-risking future cash flows in a way few industrial conglomerates ever achieve.
Yeah.
And the results, they're clear. Core revenue growth accelerated from mid-single digits up to high single digits. Operating profit margins expanded, 22.3% up to 28.6%.
Wow.
And we saw that huge increase in recurring revenue we just talked about. This fundamentally elevated the quality and the durability of Danaher's earnings stream, big time.
Okay, so with all that in mind, this high-quality transformed business, how do they protect it? Protect it from rivals? What does their competitive fortress actually look like?
Well, Danaher's fortress is primarily protected by two powerful sort of interlocking moats: high switching costs and intangible assets. And this isn't just our take, right? Leading firms like Morningstar independently give Danaher a wide economic moat rating. They see it too.
Okay, let's talk about those high switching costs first. It sounds like it's not just about the price tag of new equipment. What makes it so difficult for a customer to actually jump ship to a competitor?
It's far, far more than just the upfront expense. For customers, especially in these highly regulated environments of clinical labs, biopharma manufacturing Danaher's instruments are deeply embedded. They're part of critical workflows. So switching means significant operational disruption, think downtime, productivity loss, extensive staff retraining, and maybe most prohibitively, immense regulatory risk.
Ah, the regulatory piece.
Yeah. Imagine a biopharma manufacturer having to completely revalidate their entire production process with bodies like the FDA just to change one key piece of equipment. That's hugely costly, hugely time-consuming. And that razor and blade model we discussed, it just reinforces this inertia. Once you buy the razor, you're highly, highly incentivized to keep buying their specific blades.
Right. To really bring that moat to life, the sources point to a great example with Sephiid's GenExpert system. Can you walk us through what that actually looks like in a hospital lab, Sue?
Yeah, certainly. Picture a busy hospital lab using Sephiid's GenExpert. They use it for rapid PCR results, things like COVID, flu, RSV. This system gives quick sample and answer out results, often directly informing immediate treatment decisions. Very critical.
Okay.
Now, let's say a competitor comes along, offers a new machine. It's 10% cheaper. Sounds good, right? But what would it actually take for that lab to switch? They'd need to buy and install new hardware, retrain their entire staff on a totally new system, conduct extensive, costly validation studies to prove the new system's accuracy, its reliability.
Huge undertaking.
Huge. And then reintegrate the data output with their existing hospital IT systems. The risk of operational downtime, potential errors during that whole transition, it's immense. So in that context, that modest 10% price difference, it becomes pretty trivial. The lab will almost certainly stick with Sephiid, keep buying those high-margin, single-use test cartridges for years and years. That's the power of high switching costs in action.
Wow. Okay, that makes it very clear. And then there's that other piece, that truly unique intangible asset everyone talks about, the Danaher Business System, or DBS. What exactly is that, and why is it supposedly so irreplicable?
All right, DBS. It isn't just, a catchy phrase or a binder full of guidelines. It was born from lean manufacturing principles, Kaizen, that Japanese philosophy of continuous improvement, efficiency, quality. But DBS is more than that. It's a proprietary culture, a systematic operational methodology that permeates every single aspect of the company. It's rigorous, data-driven, designed to improve quality, drive growth, expand margins, generate superior cash flow.
Yeah.
But crucially, it's the playbook they use to integrate acquired companies.
Yeah.
They don't just buy a company. They immediately apply DBS to unlock value that the previous owners couldn't.
Ah, okay. So it's how they make the acquisitions work.
Exactly. And this deeply embedded knowledge, this culture, it's virtually impossible for a competitor to just copy because it's lived, it's breathed, it's not just documented somewhere.
Mm-hmm. So this moat then, it isn't static. It sounds like it's actually getting wider over time. How does that happen?
Precisely. It's widening. The strategic pivot into life sciences and diagnostics industries with naturally higher barriers to entry, more regulatory hurdles that inherently strengthens Danaher's competitive position. And quantitatively, you see it. That proportion of recurring revenue growing from about 45% back in 2015 to that impressive 81.11% in fiscal 24, that shows how deeply entrenched they're becoming.
Right, the stickiness is increasing.
Yes. And with each successful acquisition integrated via DBS, they expand the reach and power of that core intangible asset. It's like a growing network effect of operational excellence across more and more of the life sciences landscape.
Let's get some scuttlebutt here. What do customers and employees actually think about Danaher, on the ground? Because this is where the rubber meets the road, right?
It absolutely is. And the picture is what's nuanced. Customer sentiment for their high-end, innovative products like Sephiid, like Sativa, it's overwhelmingly positive. Lab pros frequently praise Sephiid's GenExpert for its walk-away capability, ease of use, speed, accuracy. It directly improves lab throughput. We even see academic studies confirming its excellent diagnostic accuracy.
That's strong praise.
Very. Similarly, Sativa's chromatography products, highly regarded in research, often top marks on scientific review sites, and the extensive scientific and regulatory support Danaher provides, builds deep trust for these critical applications.
Okay, but you said nuanced. The picture isn't entirely rosy across the board, is it? I saw some mixed reviews, especially for older brands, maybe.
That's correct. The picture is more mixed for some of their older, more commoditized brands, like Beckman Coulter, for instance. Some reviews describe those instruments as high maintenance, prone to frequent service calls, or even worse. There's one user comment on a professional forum saying that since Beckman was bought by Danaher, they haven't been as good. Yeah, it hints that while DBS is powerful, maybe its integration process isn't always smooth sailing for the end user, particularly with some legacy products. But it's important to remember, Danaher is strategically shifting away from those older, lower margin lines.
Got it. And shifting to the employee perspective, what does working at Danaher feel like? I've definitely heard it's a pretty intense culture.
What emerges from employee feedback, is a demanding, results-oriented, and sometimes high-pressure corporate culture. On the positive side, employees do praise the company's inspiring mission, helping realize life's potential, and the clear, data-driven framework that DBS provides. The culture of continuous improvement, internal development, it offers significant career growth for ambitious, driven individuals who thrive in that kind of environment.
But that intensity, it must have downsides too, I assume.
It can, yes. Some reviews, particularly from employees at companies Danaher acquired, recount horror stories. Long work hours, intense pressure. In some departments, the environment can be perceived as a, quote, constant dumpster fire with high turnover.
Constant dumpster fire. Okay. So, for you, the listener, what's the so what here? Is this demanding culture a flaw, or is it actually part of the magic?
That's the key question, and I'd argue this demanding culture is actually a feature, not a flaw. It's integral to their success. The intensity, the relentless focus on metrics, on performance, that's the human engine powering the Danaher business system and its exceptional financial results. The DBS mantra, people, plan, process, performance, explicitly involves assessing talent and, if necessary, removing individuals who don't fit that high accountability culture. It self-selects for results-driven people.
So it weeds people out.
It does. It selects for individuals aligned with that drive for continuous improvement. The primary long-term risk isn't that the culture is tough, but maybe that it could become toxic and drive away valuable talent. But so far, Danaher's consistent performance suggests it's a powerful net positive for creating value.
Okay, moving beyond the business itself, which sounds incredibly robust, who's at the helm? How wisely are they steering this ship? Let's talk about management stewardship.
Rainer M. Blair took over as CEO in September 2020. His appointment really represented a seamless continuation of Danaher's long-standing strategy. He came from leading their Vital Life Sciences platform, so he knew the core business inside out. His philosophy consistently reinforces DBS as the cultural and operational foundation. He's quoted saying, "Our culture of continuous improvement enables us to solve problems and deliver innovation for our customers." The focus is explicitly on long-term shareholder value, clearly an owner-oriented mindset.
And absolutely central to that long-term value creation is how they allocate capital, right?
Yeah.
Especially with those, robust free cash flows you mentioned earlier. How does Danaher approach that?
They have a very, very disciplined approach. Their primary use of capital is strategic mergers and acquisitions, M&A, predominantly funded by that robust free cash flow. But it's not just about acquisitions. They also have a strong commitment to organic growth through internal investment. In fiscal 24 alone, Danaher invested roughly $1.6 billion in R&D and another $1.4 billion in CapEx.
Okay, significant internal investment too.
Crucial for maintaining their technological leadership, ensuring they stay at the forefront of innovation.
So M&A really is the primary engine, though. Can you give us a sense of the scale of these deals and how they fit the strategy?
M&A truly is their primary engine for value creation, yes. The strategy isn't just to buy companies, it's to acquire companies in attractive, high-growth markets, and then immediately apply the Danaher Business System, DBS, to improve operating margins and accelerate revenue growth. You look at landmark acquisitions like Sativa for $21.4 billion, Paul, Sephiid, Aldebaran for $9.6 billion, most recently Abcam. These have been absolutely instrumental in transforming them into the life sciences powerhouse they are today. They even have Danaher Ventures, a venture capital arm, to invest in promising early-stage tech. Keeps an eye on the future.
And what about returning cash to owners? Shareholder returns, are they doing that?
They are. They pay a modest dividend, which they've consistently done for 29 consecutive years now. Currently yields around 0.6%. It's more of a token return, perhaps, signaling that long-term commitment. They also deploy opportunistic share buybacks when the stock seems attractively valued. For instance, in 2024 and early 2025, they repurchased about $7 billion of common stock. Management felt that provided an attractive return for shareholders at those prices.
Okay. So when you look at that whole picture, internal investment, big M&A, modest dividends, opportunistic buybacks, what's your assessment? How rational is their capital allocation strategy?
Look, the evidence overwhelmingly points to rational, disciplined, and very shareholder-friendly capital allocation. There's really no sign of empire building just for the sake of getting bigger. The systematic divestiture of those slower growth assets, Fortive, Veralto, to fund acquisitions in higher growth, higher margin sectors, that is, quite frankly, textbook intelligent capital reallocation. It's why Morningstar gives them an exemplary capital allocation rating. Hard to argue with that track record.
Let's turn to their financial fortress then. How robust are Danaher's financials, really? Can they weather a storm?
Oh, absolutely. Danaher is what you'd call a highly reliable earnings machine. They consistently generate strong, expanding profits. Their gross profit margins are robust, around 60%, and their adjusted operating profit margins have expanded significantly after that transformation, now nearly 30%. That high profitability clearly demonstrates their pricing power and, again, the effectiveness of DBS in driving efficiency.
Okay, let's dive into some key quality ratios. What do they tell us about the underlying health of the business? Maybe start with ROIC.
Right, return on invested capital, ROIC. Now, the headline GAAP ROIC has been a bit depressed recently, around 5.5% to 6.3%. This is a little misleading, though. It's mostly due to the accounting effects of those very large acquisitions that transformed the company.
The denominator effect.
Exactly. It takes time for a huge acquisition's profits to sort of catch up to its cost on the balance sheet. The underlying economic returns are significantly higher, and firms like Morningstar expect that reported ROIC will recover back to historical double-digit levels as these acquisitions get fully integrated via DBS.
Okay, that makes sense. Now, here's a ratio that's truly legendary for Danaher, right? Free cash flow, or FCF conversion. Why is this so important, and what does it tell us?
Yes. This is critical. For 33 consecutive years, Danaher's free cash flow has exceeded its net income, consistently converting over 100%. This is, arguably the ultimate sign of a high-quality business. It means the profits they report on paper, they're actually turning into cold, hard cash in their bank account, ready to be reinvested or returned to shareholders.
Real cash, not just accounting profit.
Precisely. It reflects exceptionally disciplined working capital management, a core tenet of DBS, and relatively low maintenance capital expenditure requirements. It's proof their earnings are real. It's truly the fuel for Danaher's compounding machine. It's what funds everything else.
And finally, their balance sheet strength. How do they manage debt, especially with such massive acquisitions?
Their balance sheet strength is equally impressive. Management uses debt prudently for those major acquisitions, but then they deleverage quickly through that strong cash generation. Their debt-to-equity ratio is conservative, around 32%, and their net debt to EBITDA, which basically tells you how many years of operating earnings it would take to pay off their net debt, is a very manageable, roughly 2.0x.
That gives them flexibility.
Huge flexibility, a significant margin of safety, and ample financial firepower for future M&A, and their interest coverage ratio, indicating their ability to pay interest on their debt, also very healthy, around 23x. Rock solid.
So, okay, we've definitely established this is a wonderful company, as Buffett would say, but the real question for any potential investor is, can you buy it at a fair price? What does the current valuation look like?
Right. Looking at current valuation ratios, the price to earnings, or PE, on a trailing 12-month basis, TTM, is approximately 38x to 39x. That tells you investors are paying quite a bit for each dollar of recent earnings, often signaling high growth expectations, and the price to free cash flow, PFCF, TTM, which, as we discussed, is often a more crucial measure for a cash-generating business like Danaher that sits around 27x to 29x.
Okay, 38 PE, 28-ish PFCF. And how does that compare to its own history? Is that high, low, or sort of typical for Danaher?
Well, the PE ratio is slightly above its 5-year average, which is around 36.6x, so a little elevated there. However, that PFCF ratio, it's actually pretty much in line with, or perhaps even slightly below, its recent historical average. That typically floats in the high 20s to low 30s range.
So PE a bit high, PFCF may be reasonable.
Exactly. And here's a crucial judgment call, I think. Danaher is a business that deserves and will likely always command a premium valuation. The quality is just that high. So the current price, yes, it appears demanding, but it's not necessarily unfair for an investor with a multi-decade time horizon. And here's the reasoning. First, the fundamental quality of the business has significantly increased over the past 5 years due to that strategic transformation we discussed. So paying a valuation roughly in line with its 5-year average for what is now a better, more resilient, faster-growing business, that could actually be considered quite reasonable.
Right, you're buying a better company than 5 years ago.
Precisely. Second, that P/FCF ratio, which is arguably more relevant here, isn't at an extreme level historically. And third, the stock is trading significantly below its 52-week highs right now. That reflects the market's current concerns over those short-term headwinds we'll touch on, which could offer a potentially more attractive entry point for the long term. For a truly wonderful company, waiting for an absolute bargain often means missing out on years of compounding.
Fair point. Okay, speaking of the future, what's the primary engine you see driving future growth for Danaher? And on the flip side, what are the major long-term risks? The things that could permanently impair the business?
The single most important engine for Danaher's future growth, I believe, is its deeply entrenched position as the essential tools and consumables provider for the ongoing revolution in biotechnology and genomic medicine. Those strategic acquisitions like Sativa and Allocation, they place Danaher directly at the epicenter of this massive multi-decade trend. As advanced therapies, cell therapies, gene therapies move from research labs to full-scale commercial production.
The demand for their stuff skyrockets.
Exponentially, especially the demand for their high-margin recurring consumables. This is a durable, long-term tailwind that's just not going away. It's fundamental.
That sounds like a powerful driver, absolutely. But every company faces risks. What are the biggest threats, the things that could truly undermine Danaher's long-term success?
Okay, risks. First, and maybe foremost, given their strategy, is the failure of the M&A engine. Their growth model is fundamentally dependent on successful acquisitions and integrations using DBS. If they were to massively overpay for a huge acquisition, or if DBS somehow failed to generate the expected synergies in a large, complex new target, that could lead to significant goodwill impairments, value destruction. It's arguably the single greatest internal risk.
Right. M&A is their superpower, but it's also their potential Achilles heel if it goes wrong. What else?
Second, technological disruption. The life sciences field moves incredibly fast. Innovation is constant. A formidable competitor, think Thermo Fisher, Agilent, maybe someone new could develop a truly disruptive new technology, something that renders a key Danaher product line obsolete. Now, Danaher invests heavily in R&D and uses M&A partly to mitigate this risk to buy innovation. But being on the wrong side of a major paradigm shift is an ever-present risk in any high-tech field.
Always a possibility. And finally, competitive or broader economic pressures.
Yes. Third, intensifying competition and regulatory roadblocks. The attractiveness of Danaher's markets has drawn strong competitors. Increased industry consolidation could eventually lead to more pricing pressure, squeezing those high margins. Also, as Danaher has grown so large and dominant in certain areas, it's naturally attracting greater antitrust scrutiny from regulators. A future environment where regulators significantly block their M&A strategy, that could permanently stunt their primary value creation method.
A real constraint on their model.
Absolutely. Plus, it's worth noting, China makes up approximately 12% of their revenue. That adds a layer of geopolitical risk in the current global climate that you just can't ignore.
Okay, that brings us to second-level thinking. Given all of that, the strengths, the risks, the valuation, what do you think the market might be missing when it looks at Danaher right now? What's the nuance?
Well, the current market consensus seems pretty clear. Danaher is a very high-quality company, excellent long-term story. But it's currently facing significant short-term cyclical headwinds. The market is very focused on the post-COVID inventory digestion and bioprocessing companies stocked up during the pandemic. They're focused on the sharp drop in that high-margin COVID test revenue for Sephiid, and also funding pressures in China impacting research budgets. So the consensus is sort of cautiously waiting for growth to visibly reaccelerate.
Okay, so the market sees the current challenges, but what's the deeper insight? What's the contrarian angle, maybe?
Our analysis doesn't really dispute what is happening in the short term. Those headwinds are real. But for a long-term investor, the implication is potentially quite different. The market appears to be overly focused on the precise timing of this cyclical recovery. And in doing so, it might be fundamentally underestimating the long-term compounding power of this newly transformed, higher-quality portfolio.
So focusing too much on the next quarter or two.
Exactly. This slowdown isn't really a question mark over their long-term future. It's more like a predictable, temporary normalization after an absolutely unprecedented surge in COVID-related demand. The underlying secular growth drivers, aging populations, rise of biologics, need for faster diagnostics, those haven't changed one bit. They're still firmly in place. So the market, in essence, sees a temporarily stalled engine. This deep dive suggests it's more like an engine being refueled for a longer and ultimately faster journey ahead. The temporary slowdown might be providing a rare opportunity to acquire shares in a superior business before its powerful new earnings engine fully reaccelerates.
Interesting perspective. Okay, let's try to synthesize all of this. Let's summarize the core investment thesis, the compelling reasons to be excited about Danaher long term, and then the crucial risks to keep front of mind.
Okay, the bull case. The reasons to own Danaher for decades. First, superior business model in durable markets. High margin, high visibility, razor and blade model. Over 81% recurring revenue, providing essential picks and shovels to non-discretionary life sciences and diagnostics. It's a great place to be. Second, widening competitive moat. That powerful dual moat from high switching costs and the unique Danaher business system, DBS. And it's demonstrably widened because of that strategic portfolio shift into stickier businesses. Third, exceptional capital allocation and culture. Proven multi-decade track record of creating value through disciplined M&A, fueled by DBS. Management's interests are clearly aligned with long-term owners. And fourth, financial fortress. It's a world-class cash flow compounder, remember. FCF greater than net income for 33 straight years. Plus a pristine balance sheet giving resilience and future M&A firepower. It's just a financially superb company.
Okay, that's a strong bull case. Now, what about the bear case? What are the counter-arguments, the core risks that could derail this whole story?
Right, the bear case. The counter-thesis. First, valuation demands perfection. That premium valuation, around 38x PE, maybe 29x PFCF, leaves very little margin for safety. Any stumbles, any failure for growth to reaccelerate as expected could lead to significant multiple compression. The stock price could fall sharply, even if the business itself is doing okay.
High expectations built in.
Very high. Second, M&A execution risk. As we said, their growth model depends heavily on M&A success. A single, large, failed acquisition, overpaying, integration failure could permanently impair capital and destroy that value creation algorithm. It's a key dependency. Third, technological obsolescence. Rapid innovation in life sciences means a disruptive new technology from a competitor could erode their moat faster than anticipated. They have to keep running fast just to stay ahead. And finally, macro and geopolitical headwinds. A prolonged global recession could eventually impact even non-discretionary R&D budgets. And that significant China exposure, about 12% of revenue, creates ongoing geopolitical risk.
Okay, comprehensive risks there. Let's end with a red team challenge. If you wanted to make the absolute most compelling argument for why investing in Danaher today might be a long-term mistake, what would that argument be? What's the strongest counter-narrative?
The strongest argument for a long-term mistake. I think it would be if the core assumption about the omnipotence of the Danaher business system proves to be a myth of the past.
Interesting. So questioning the DBS itself.
Exactly. To elaborate on that inverted thesis, what if DBS, which was perfected for driving operational efficiency and margin expansion in more traditional industrial companies, what if it's fundamentally less effective at driving true breakthrough scientific innovation in the complex, fast-moving, research-intensive world of life sciences? Could the rigid, process-oriented, sometimes cost-cutting nature of DBS slowly, inadvertently, strangle the very creative, research-driven spirit that made companies like Sativa and Abcam such attractive acquisition targets in the first place?
And we did see those mixed customer reviews for Beckman Coulter post-acquisition. Maybe that's a potential canary in the coal mine for this exact risk. Suggesting DBS doesn't always translate perfectly, especially where maybe innovation culture is paramount.
Precisely. If Danaher's M&A and squeeze model, as some might call it, causes it to fall behind on the actual innovation curve, then its moat, which looks so strong today based on switching costs and current tech, well, it could become far more brittle than it appears. Customers would eventually bear those high switching costs grudgingly to move to a truly superior next-generation platform from a competitor if the performance gap became too large to ignore.
And in that scenario, the growth engine sputters, that premium valuation collapses. And Danaher is revealed not as a life sciences leader, but maybe as an industrial conglomerate that strayed too far from its roots, turning what looked like a wonderful company into potentially a decade-long value trap. That's the nightmare scenario.
That's the red team challenge, yeah. It hinges on whether DBS is universally applicable or if it has limits when it comes to fostering cutting-edge scientific progress.
So there you have it. A really deep dive into Danaher, a company that quietly, methodically builds its empire on the essential tools of scientific progress and patient health. a true behind-the-scenes powerhouse.
Yeah, and this whole deep dive, it really raises an important question, I think, for all of us looking at businesses. In a world of increasing complexity, rapid technological change, how much of a company's enduring success relies on its specific industry advantages versus the adaptability and foresight of its core operational system, like Danaher's DBS? Is it the industry or the system that matters more?
That's a great question to ponder. And what stands out to you listening today from our deep dive? Maybe consider this. If the Danaher business system is their ultimate intangible asset, that unique process or approach that makes them so effective, maybe even irreplaceable in their field, what would be your equivalent? In your own career, your own life, what's your unique system or approach that creates lasting value? Something to think about. Until next time, keep digging, keep learning, and keep asking those deep questions.